All right. Good morning, everybody. So yesterday proved to be a hurry up and wait. We want to continue to find that idea holds and then plan for what if it doesn't. That should get us through the day and set us up for tomorrow. Japan up around 0.5%. Europe closer to a quarter with Hong Kong, and then US markets are flat to red. We got pending home sales today. It's not really a big one that I would focus on, and the numbers aren't very far apart. Not a lot of room for a miss in that. What I'm more focused on today is the 20-year bond auction. So we have a 1 o'clock auction that can mess with your afternoon 0-day trades. We'll have to make it through that 20-year, get on the other side of it, see if the market really has a response from it. I can see they've got the monthly budget statement lit up as something that can cause some drama. These little impact markers are based on historic precedent, so I would not discount it. It's not generally something that I would focus on too much, but I'm not going to argue against a heads up. So take what we can get, right? Watch that 20-year, even though it says it's not a high impact. To me, it's the biggest thing on the table today. But behind that, just keep your eye on that 2 o'clock monthly budget statement. Of course, NVIDIA is going to be chipping its teeth this morning at the NVIDIA AI conference. It, it is absolutely possible that we see the market wash it after that. Sell the news. If he doesn't come out and say really good things, or maybe he does. Maybe he comes out and convinces everybody that they should continue to pile money into this and we go up from there. So just keep your eye on an exuberance move. See if he can rally the leaders. If you look at the FedWatch tool, you will find a priced in rate cut in December. Anything before that, all right, well, this one is right on the line. And that would be October, but that's too darn close. And earlier when I was looking at it, they were like equal or a little less. But look at September, June, July, April. The cut has been unwound. Now on the other side of that, if we're looking for any excuse to see the S&P and NASDAQ, the indices begin to climb up, all it would take is for the market to start pricing in rate cuts all along the curve. June, July, September, October, December, and it doesn't have to be heavy. They just got to start pricing it in because they've been unwinding it. And we've seen this sideways to declining market. So you want a slow grind back up. That's all it would take. If they were to come in heavy and quickly, then of course we'd see that response in the market. Energy dominance again this morning. Yesterday, the VIX was a really great tell for half the day. right? Take what we can get. Remember, the market you're wanting to trade is very likely being influenced somewhere else, especially if you're running the indices. All right, the SPX reference price 6701. That's basically 6700. It's this line right here. So we're resting on that. If it breaks, we've got 6650 and then 6600. It's the biggest level we've got. To the upside, if we hold 6700 and try to push higher, 6750, 68, then we cross 6850, 69. Sitting here with structure on each side of us, it kind of begs the question, what's going to give us the juice to climb that wall? What's going to get us through these levels? We got to get through FOMC first because there's just a real lack of participation in front of FOMC. And it makes sense, right? If you're running very large assets under management, why would you guess or assume that you know the forward outcome? Just sit back and let the Fed tell you what they're going to do. CTA positioning, it start to curve down just a little bit more. Consider that like the rate of change. That dashed line that you see there is the zero line. So we are below zero. This is the change in their positioning. You see their rate of change has increased. I'm really surprised how well the VC funds are holding up, volatility control funds. But I don't know why I'm surprised. I just am. We have moderate risk coming out of the White House today. This number can change through the day, so just keep your eye out. See if he's going to have a meeting anywhere, if he's scheduled to talk, if he has some impromptu press conference, anything like that that can change this number. All right, the pull wall rolled back up just a little bit between yesterday and today. You can see we're dancing around the threes, whether it's the 3-day or the 3-week. It's those two white lines. We're holding above the 200-day moving average this morning. It's this purple line right there. We've got the 10-day, the 10-week, and the 20-day still sitting overhead with the volatility trigger and zero gamma. Way up yonder, we got the call wall. Now, it's very likely that when we get through OPEX and we get onto the other side of it, that call wall is going to be in a more strategic location. for right now, it seems to be a forgotten player. They just got it out of the way and they haven't looked back at it. Overnight volume at 85,000. Looking at yesterday with 81. It's still heavier than our norm of the 50s that we're used to, but it's light in the context of what we've seen over the last 2 weeks. We've really seen triple digit numbers frequently, and now we don't have that. It stands out, that lack of participation in front of FOMC. Little bit of a round trip last night. With all that movement, we never got outside of yesterday's range. Sure, we got out of the RTH, but we didn't escape the total range of yesterday. Yesterday was a wide range bar. So we dipped down, turned around, do-si-do, and back up we go. 67.50, we're running 50s. It's right at the 3 week. We got to get through this level. But where's the fuel going to come from? Where's the trust, the forward guidance, and the initiative? There's just no reason to see anything like that come in. So great, we're basically where we started. If you look at change percent on the day, it's less than a dime. We got nothing. So if we can break our own Globex high, then we can challenge yesterday's high, which is the 10-day moving average. And if we get through that, we can challenge the 10-week and then the 20-day. And I'll continue to ask, why would we? This watch list here on the side is my volatility watch list. If you don't have futures data, you can use the VIX ETFs or ETNs. There's a lot of them. You got the VIX 1-day, 9-day, 3-month, 6-month. There's a VIX 1 year, and then there's just the plain old regular VIX. Kind of tie them all together. What you're looking for is the difference between backwardation and continuation through contango. We're not there, but the curve is flattening out. If you do have the futures, then, it's kind of a little cleaner, I think, but still, same thing. We're not seeing backwardation in the VIX yet, but the curve is flattening out. Maybe it's a little too early for the nerd talk, huh? You like it. You got to ignore the market maker move. It's because of OPEX, especially triple witching OPEX. We're going to see that every day this week. Unfortunately, even if there was something that was actually causing them hedging, we wouldn't be able to differentiate that between the OPEX data that we're getting in anyways. So, no system is perfect, and using that market maker move most of the time is really effective. But on OPEX week, it's worthless. We didn't hit the lower ADR. It's very likely we're not going to hit the upper ADR either. And the idea of hurry up and wait is strongly in place. We did yesterday what I was going to talk about more yesterday is that we reached the edge of the weekly expected move on Monday. There's plenty of examples of an FOMC week where we do that. I didn't have a chance to highlight it yesterday as well as I wanted to, but go back and mark out FOMCs in the past. Look at the week that they had, and you'll see that a lot of those made it to the edge of the weekly expected move on Monday and or got close Monday and then tagged it on Tuesday. And that's where the market shut down and waited for FOMC. We just didn't get anything else. We didn't retrace either. And that's important to understand. We did rise up, yesterday, right? Look at where we opened on Sunday. We made that wide range bar. We set a pretty decent high, and then we closed within that range for the RTH. A lot of the examples of those FOMC weeks where we made a run and then stalled out, very rarely did we retrace everything and then go into FOMC. So I'm not saying we can't go back down to Sunday's levels, especially with headlines or some sort of news or something that could jack us down there. But it's going to take something like that to get us down there. Today's floor pivot is higher than yesterday. That's bullish. Price opened above it. That's also bullish. We don't have an MDP because we've already come down and hit that pivot. We don't need to worry about it. And in fact, after hitting it, we crossed below it but came back up through it, and that's bullish. We're outside of the pivot channel, and we're continuing to try to hold and push farther away from the floor pivot. All of that is bullish. It's very likely that if we retest the pivot low, the pivot channel low, that we're going to get back inside of the weekly pivot channel, and that'll open the door to get down to the weekly pivot 6690 basically. So a little destination trading there. All we got to do is break our Globex low, and we got a nice shot down to 6690. I like it. You get through that, and we can target Friday's low or Sunday's open, whatever you want to call it down here, 6660. The path of least resistance appears to be to the upside. This is the distance from the floor pivot to S1. This is the distance from the floor pivot to R1. You can see that R1 is further away than S1. Path of least resistance is up. That does not mean we're going to go up. Those lines themselves are nothing more than a math formula. They don't have bias within a trade. If we want to hit the upper line, the R1, we're going to need an inside day breakout, get above Monday's level, get through the roundy, and then hit that R1. Now we can do that, but we're going to need some fuel somewhere, right? We got to gas up. The point of control that we built out from last week continues to be the point of control that we're building out for this week. Lots of structure here. And it's very likely that this is our zone that we sit in into FOMC. We've made our bed and now we're lying in it. Now, it is possible that we get out of this box and begin to expand. To the upside, that would get us tangled up around 6,800 and into all of this trash, with a point of control back here at 6870. The last time we tagged that level, we were soundly rejected and down we went. I have no doubt whatsoever that that is still a strong structural level that we're going to need to deal with. But that's a lot of work. just getting into 6,800 would be a monumental effort. Then getting through all this trash. To the downside, breaking that Globex low that I mentioned gives us a chance to challenge more of yesterday's price and get down into this multi-layer POC 6625 area. $10-day, 30-minute volume profile in TPO. It's quite an ugly mess that we have here. Lots of distribution zones, shallow areas. Within the end of the week, we should be a little narrower than we are right now, unless we go back up there and put new footprints in. So the expectation is that 6,900 will be the cap on this 10-day profile by the end of the week, or at least by Monday when we come in next week, unless we break that 69 between now and then. Otherwise, sitting inside of this distribution range, things are pretty ugly. We are in the value area, although we're hugging that low, and any move to the upside while we can get through this shallow area is going to put us into that point of control. We've had a hard time getting through all of that before. But you can see, looking in the past, when we got there, it wasn't a simple rejection and a fade back down. Instead, we were embraced. So we could get stuck there again. We have a VPOC from yesterday. A little bit of a surprise, but we'll take it. Now, I don't zoom into these things and get them to the tick perfect. I'm just not interested in doing that. You do you. It's the point of control from yesterday, and we have not hit that point of control yet. So if we make a move to the upside, we're going to have to work through that level. So far, it looks like they're defending against that level and front running. All right, so this is what I was talking about. Making it to the edge of the weekly expected move on a Monday, or getting close to it on Monday and then finishing it up on a Tuesday. The FOMC week very often has a very narrow weekly range. So it's a lot easier to get to the edge on an FOMC week because the edge is a lot closer to where we start. I mean, that should make sense, right? You don't have to travel so far to get there. And then if you go back and look at a lot of the FOMC weeks, when we've made this move, whether we went down to the edge or up to the edge, it's very rare that we leave that edge on an FOMC week and we go to the other side before FOMC. Going back and looking at how often we've reached that edge, getting back to the midpoint, getting back to Friday's close is rare. So when we make a move like this on an FOMC week before the event happens, we usually keep it. So I would focus on the midpoint of yesterday and this wick zone of yesterday. Because if we continue to rally, staying in the wick zone makes perfect sense. We could just sit up there, hurry up and wait, get into tomorrow. And if we can't get up there and we can't stay in that zone, then holding above the midpoint makes sense. Just because we don't normally go down to the Friday area or we don't go to the other side before FOMC normally, don't write it off. If we break that mid, we're just going to play it level by level like we always do, right? If we break yesterday's mid, we target yesterday's low, and that happens to be Friday's close. And if we break that, then we target the other side and we just keep running it, right? We got the 111, the 1, 2, 3, 6, and we'll run the expansion and just take it level by level. The base case is we're not doing any of that. But there's plan A, and then there's plan B. We are still below the 10-day, but we're up off of those lows significantly. That's the turnaround that I was talking about last week. Once you get 1.5%, 2% below the 10-day, you tend to revert back some. A lot of times that reversion back gets you across the line and onto the other side. Other times, just getting that deep brings you back into a half or a 1% zone. That's where we're at right now. What we want to watch for is a relapse back down into the lows. If you zoom out and look, there's been a lot of examples where we dip down to 2, revert back around a half or 1%, and then dip back down again. So getting 2% below the 10-day moving average again isn't off the table, but I don't see it happening before FOMC, because that would be very rare at this point. We are 1% below the 10-week. We're doing better than we was last week. There's nothing wrong with this position being right there at that 10-week. It's basically being in the center of the court. So we've got from here a good 2 to 2.5% move that we could make up or down, and we wouldn't be out of control, overbought, oversold, overextended, nothing like that. So this is pretty healthy, all things considered. It would be better, obviously, if we were above the 10, but when you're this close, above and below, it doesn't even really matter. We're there. We can cross back and forth through it like crossing the border. Looking at what's down this morning, uranium, gold miners, junior miners, really even the miners we'd have to reach because they're not down 0.5%. So we've got uranium, and the Mag 7 up volume is down, and really that's all we've got. We got nothing. If we look at what is weak this morning but not down enough, we've got some really important ones that are down there. Chips, communications, growth. We need those if we're looking for a rally day, right? IGV is like their software, generic tech, the mags. We need these for a rally day, and we don't have them. The good thing is they're slightly red. It'll be very obvious to spot them if they come to green and then start increasing that green position. You can't miss it. It'll be very obvious. So if we get a turnaround Tuesday and these all start to turn green, it's much more likely we're going to get that rally and that continuation, and we'll challenge yesterday's high and keep pressing to the upside. That would be the breadth that we're looking for to raise the boats in a rising tide scenario. We're not expecting a rising tide scenario, right? We're expecting to hurry up and wait. Looking at what is already up this morning, energy, yeah, that's a surprise. Airlines, which doesn't make any sense. They're not getting paid, and energy costs should be kicking their butt. little bit of China, nat gas. So we got nothing here either. You don't want a rally day based on any of these. It's unsustainable. So these don't have to go down for us to rally. We just need something else to outperform them, to do better than them. That should be pretty obvious. If anything on the red list changes its direction and outpaces any of these things, that would give us some rising tide effects. So all things considered, we got a reasonably decent setup this morning. GTFO, got to get out of the box. As always, it's the same old thing. There's your box. You got to get out of this to get anything else done. Keep your eye on the mid. If we break back below the midpoint, then we'll challenge the low and then begin that expansion back down to Friday's low and on to the other side. Otherwise, just keep in mind that daily bar. The wick on top is its own structure, which is anything above our Globex. That would be the wicky part of yesterday. That's a zone all by itself. Then there's yesterday's body. Break our Globex low, we can retrace through yesterday's price. And we can get stuck there, waiting on FOMC, because it doesn't owe us a move. The Globex low is just slightly below yesterday's full move. So that's the midpoint. I would use the Globex low rather than that mid. And game on if we break this Globex low. Simple enough. So all things considered, we got a decent setup. But if we stay in the upper part of this range, that wiki area, it's very likely going to be choppy, violent, not much fun to play. On the other hand, if we use all of this, so if we stay down here in the RTH, it's not going to be very pretty. If we stay just up here in the RTH, it's also probably not going to be very much fun. You're not going to enjoy that. If we use all of this, we have enough room to get some decent price action. So today doesn't have to be a complete wash. There could be some decent setups. It just depends on if we're going to use one box or both boxes. I don't really care which way. I'll take what I can get, right? No reason to guess or assume either. I get that question at least once a day. What do I think it's going to do? Go up from here or go down from here? I don't care, and I'm not in the guessing game. If it breaks the top, I'm going to trade that. If it breaks the bottom, I'm going to trade that. I don't need to guess or assume before it breaks which one I think it's going to do. Destination trading, if we break this level, we're aiming for the top, right? So I got for you guys, be careful, be safe, watch the news, keep your eye on the headlines, watch the clock. I'll see y'all tomorrow.
Recording stopped.